Good morning and welcome to the Canaccord Coffee Break podcast. I'm Jane Parry, the Chief Marketing Officer here at Canaccord Wealth, and I am delighted to welcome back Tom Hibbert from our Chief Investment Office, back from his holidays in Scotland, camping.
I am. It's good to be back.
I know, camping.
It was great fun in Scotland camping, a bit rainy.
Bit rainy?
The last 3 days were just straight rain. So
if I tell you we had 30 degrees down here, you'll be pleased to know that, won't you?
Yes. Yeah.
And the midges?
Quite nasty, but we were fairly well prepared for that.
And how was the coffee?
Good. You know, I had a percolator.
You had a percolator in a tent?
Yes.
That's a very posh way to camp, that's all I can say.
I think particularly when you're camping, I like rocket fuel coffee in the morning. So yeah. Percolator.
Well, welcome back. I hope you're all rested.
Good to be back. I am.
All rested. Here we go. This week's Coffee Break podcast, as you know, trying to cut through all the noise, demystify what's happening in the markets, and then help our listeners feel more informed, confident, and in control of their financial future. So this week, I would like to talk about what surprised me in the markets. So the US stock market looks like it's gone nowhere in the last couple of months.
Yeah, it's down 1.2% from the end of May.
But 60% of the companies that make up the US stock market actually saw their share price rise in that period of time.
Yes.
So a bit of a mystery to unpick, and I wanted to understand what was going on underneath the bonnet, or because you've been camping, perhaps it's underneath the canvas whilst you've been away.
I was camping in a Land Rover Defender.
Oh, here we go. Yeah, no canvas. All right. So it was underneath the bonnet then. So what does this mean? What's happening? So let's grab your percolator and let's dive on in. Could you just, first off, give us just a quick summary of what's happening?
Yeah, absolutely. So we had a very strong rally driven by the technology sector in particular through the spring. And in June and July, we're seeing some quite material weakness. So we're calling it the summer semiconductor swoon, we could say. It started off as the June swoon, but it's continued into July. So we're seeing some tech weakness. Overall, and just to focus on the US, because it's the best, clearest example of that, but we're seeing the same pattern across the global market. You know, the US has delivered a return of minus 1% since the end of May. Underneath the bonnet, though, most companies are performing really quite well. 60% of stocks, over 60% of stocks have delivered positive returns, but the weakness is concentrated within tech. That is, the tech sector's fallen 6%. Communication services, so quite a lot of that is tech related, has actually lost close to 8%. The semiconductor industry stocks have declined 10%. That's a component of the tech sector. So weakness there, which is driving the whole market or at an index level down,
because they're
such a big component of the index, and there's quite a lot of weakness there. Whereas the broader market is actually performing very well, and there are a couple of reasons for that. One is that there is, despite still strong earnings and strong economic activity that we're seeing, there is greater scrutiny over the AI build-out spend and investments that we're seeing there across the whole pyramid. And the reason for strength across the broader market is that the actual economic backdrop is still, and the corporate landscape is still very positive. So it's really a positive story that we're seeing, a broadening out of market leadership.
So broadening out of market leadership means other people are rising up, so we're not so dependent on the Mag
market,
7 or the technology stocks.
Exactly. That's right.
So just go into the ones that are coming up to take up some of that slack. What sort of sectors, companies, industries are we talking about there?
I'd highlight two because it's coming from two areas, really. I mean, it's very broad. It's coming from the whole market, basically.
Yeah.
But
we've only got 10 minutes.
I'd frame it in two ways. The first is we are seeing a bit of a cyclical upturn. In the global economy at the moment. And we're seeing global manufacturing activity still firmly in expansionary territory. Services activity is also in expansionary territory, but has been for a long time. We're seeing an upsurge in manufacturing. And that is supportive of some of the more cyclical areas of the equity market.
By cyclical, you mean?
Areas, industrials, things like that, are performing very well. And then on the flip side, because you've got investors are a little bit more cautious around the tech capex and following a period of strong performance within technology, there is a little bit of a defensive undercurrent to this market rotation at the moment.
Okay.
So investors are selling their tech stocks that have performed very well, and they're starting to buy very cheap and some would say relatively undervalued defensive companies.
So
in
defensive
things like
companies,
consumer staples.
Yeah. So that's what sort of things comes under consumer staples?
Those are consumer goods that are less tied to the economic cycle. So non-discretionary consumer. Yeah, basics. So, cleaning products, food.
Right.
And then healthcare performing well as well. So two components to that. I would say the cyclical parts of the market doing well in June. Some of the defensives are performing particularly well in July. But both of these things are happening at the moment.
Okay. Plus the tech bubble coming off a little bit.
Exactly right.
Okay. So this market breadth.
Yep.
That's a sign of strength, not of weakness.
And the reason it's a sign of strength is because we're also seeing such fantastic earnings still coming through.
Right.
So we're in the middle of earnings. There's earnings season at the moment. Q2 earnings companies are reporting at the moment. We're about a third of the way through that. We're on schedule. And sorry to focus on the US, but it's such a good example. We're on schedule for a 9th consecutive quarter of double-digit earnings growth.
That's amazing, isn't it?
It really is amazing. It's broad earnings strength, which is actually the earnings growth is still concentrated with. Yeah. It's still the best example of that is still within tech.
Yeah.
Which we can touch on, but there's such earnings strength combined with strong economic activity. Balance sheets are strong, the corporate landscape's strong. All of this is supporting a broadening out of the equity market. The reason why we've still got strong results within tech, but we're seeing weakness within the sector, is because analysts aren't concerned about current profitability, particularly at the bottom of the AI capex pyramid, because the flow of capital is going down the pyramid, particularly to the chip manufacturers. They're very profitable, but there is scrutiny about how sustainable this investment is.
Yeah. Which we have talked about before.
Which we've spoken about before. And that is the key question now.
Okay. So a reason for measured confidence, but not a guarantee all markets will continue rising, I guess, at the moment.
Yeah, I think you've got to pick your spots and pick
carefully
how you build your portfolio.
As ever.
And we would recommend, Leah spoke about diversification last week.
We did. We talked about the football team, attackers and defenders.
Yes.
And a bit of midfield.
Yeah, okay,
We even
exactly
talked about Harry Kane.
Okay.
You should listen to it.
I should do. But balancing, capturing the opportunities from this strong earnings backdrop alongside the relative value opportunities in defensive sectors.
Yeah.
You get this ballast between more defensive relative value and quite exciting opportunities within industrials in particular.
So just thinking about our clients and our listeners, what does this all mean for investment portfolios then?
Well, it means that the outlook is still broadly positive, that we are still seeing the economic landscape is still very good. We're still seeing good growth. We're seeing good corporate earnings coming through. So that is quite exciting. And we're still broadly, mostly positive.
Yeah.
And it's helpful for diversified portfolios, which is, it's good if you see a more material sort of tech weakness. Amidst still a strong economic environment, your portfolios can still perform well.
Yeah.
So you don't want to be too. You want to maintain a diversified overall portfolio, and it's good to see a broadening out of performance. It's in fact it's healthy.
Yeah. Okay. Nice. Thank you. I think I probably should sum up what is in my Canaccord takeaway coffee cup this week. So we talked about the froth in the headlines, and they have once again been focused on what we've called the semiconductor summer swoon.
Yes.
But beneath the surface, something more encouraging is brewing in my coffee cup, I think. It sounds like most companies are on the rise. The earnings season is strong across the board so far, anyway.
Absolutely.
And as a result, the market's leadership is broadening out beyond a narrow group of tech giants, which for clients and those people preferring a more diversified portfolio for the longer term feels like that's a sturdier way to go. Standing on more legs than balancing on a couple.
That's right.
And for long-term patient investors, I think that sounds like a good reason for quiet confidence going forward.
Exactly right. I think there are 4 pillars to look at,
Yeah.
to really look at the moment. One is the broadening out trends that we've discussed today. The second is the solid earnings landscape that we're seeing across the board. And then some of the concerns around increased competition, particularly from China, poses a threat to
the DeepSeek question.
Western technology companies. The DeepSeek question, exactly. And then connected to that, all of the investment that we're seeing, $500 billion of investment into the AI build-out from the hyperscalers this year. I mean, it's vast. And we're seeing a little bit of indigestion there as investors are scrutinizing that investment cycle.
The right thing to do as well.
Absolutely.
Yeah, good. Thank you very much. Welcome back.
Thank you.
Been missing you the last couple of weeks.
Oh, that's very kind.
And thank you to everyone for listening to the Canaccord Coffee Break podcast. We hope you've enjoyed it. Don't forget to hit follow on your preferred podcast channel of choice so you don't miss an episode. And as always, we'd love to hear your thoughts, your feedback, your challenges even. Drop us an email, coffeebreak@canaccord.com.
And thank you for all the helpful feedback.
Yeah, really helpful. Yeah,
it has been good. So thank you.
Thank you.
Investment involves risk. The value of investments and the income from them can go down as well as up, and you may not get back the original amount invested. Past performance is not a reliable indicator of future performance. The information provided is not to be treated as specific advice. It has no regard for the specific investment objectives, financial situation, or needs of any specific person or entity. It is accurate at the time of recording and is subject to change.